In this lecture, we're going to be talking about the Sharpe ratio. So what is the Sharpe ratio? The definition here for Sharpe ratio, straight from Wikipedia, is that in finance, the Sharpe ratio is a way to examine the performance of an investment by adjusting for its risk. The ratio measures the excess return per unit of deviation in an investment, asset, or trading strategy, typically referred to as risk, named after William F. Sharpe. So the Sharpe ratio basically permits us to know how much money we're making, what is the returns that we're making for each unit of risk that we've taken. Because like we've said, the objective here is not to only look at return, but look at return versus risk. It's very important how much risk we're taking. Now, initially when the Sharpe ratio was, invented and used, was to compare different mutual funds. You had a bunch of funds. Let's say you had one fund, let's call it Fund A, and then you had another fund, Fund B, that gave you different performance for the year. So as an investor, you don't always know which fund you should invest in, right? For example, let's say the first fund here gave us, at the end of the year, gave us maybe, let's say 50% return, right? And then you had Fund B that gave us maybe 20% return, right? So Fund A versus Fund B. Now, which portfolio or which fund should you invest in? If you just look at them like this, maybe somebody's going to be like, hey, I want to invest in the one that was able to generate 50% return. But the problem here is that this fund took on a lot of risk. You see all these drops here. Imagine this fund had drops of 40%, right? Huge drops. Well, the problem with a fund like that is if you invest at the wrong time, imagine you invested here, well, you would have lost a lot of money, right? And the potential for you to invest and it dropping a lot is high because it is very volatile. But this fund, for example, maybe the drops that it had were very small. So yeah, even though it gave you less return, it was taking on so much less risk that return is actually amazing compared to the risk that it's taking. For example, imagine this one has a volatility level, because this is where volatility comes in. We want to not only look at the end result, but the deviation of the returns throughout time. So how volatile are these returns? And we already learned what we use for volatility, right? We use the standard deviation. So imagine that the standard deviation in this fund, when we compute it, it gives us something like, let's say 40%. So the Sharpe ratio is going to be calculated by looking at the return divided by the standard deviation. So if this one gave us 50% return, but the standard deviation of the returns is 40%, then it gives us a Sharpe ratio of 1.25. Now this one, imagine the Sharpe ratio here is, the return was 20%. Divided by the standard deviation. Maybe the standard deviation here is only, 4. So 20 divided by 4, that gives us 5, a Sharpe ratio of 5. What does that mean? That means that this fund, because it's 5 over 1, right? We remove the 1 because it's 1. This means that this one is giving us 5% return for every unit of risk that it's taking, every 1 unit. And this one is giving us 1.25% return for every unit of risk that it's taking. So this one, for the same amount of risk, this one is giving us way much more return. So this is the one we should invest in, right? Because we are smart investors, trader, we look at risk because risk materializes. Don't ever forget that risk materializes. People tell you take risks, but you have to understand that in trading, risks will happen because you're trading often. So you don't want to take unnecessary risk. So this is where you would invest in. This is how people used the Sharpe ratio for mutual funds, right? They had a bunch of different mutual funds, and by looking at their Sharpe ratios, they would be able to know which which they would be able to compare funds with one another. Okay. Now, when the actual function of the Sharpe ratio, they usually remove the risk-free rate here, but we're not going to do that because we're trading, and in trading we don't care about the risk-free rate. It's so minuscule that it's not worth it. But we do it a bit differently. So let's come back here and look at the Excel sheet that we've had before. Okay, we've had this. Now, what I would like to do is actually calculate the Sharpe ratio for these strategies, right? I want to know what the Sharpe ratio is to know which strategy is better. Well, how would I do that? First, I have to look at the average daily return. Average daily return. Okay, well, let's check it out. Average, I can just average these. I can already tell that the average is going to be 2.1% because the total return is 21% and we have 10 trades, so it's 2.1, 21 divided by 10. And here the average return is going to be the same thing. Now what I want to do is now, already I see that these two strategies give me exact same returns, but the volatility is not the same. We know that this one is way more volatile because of these two, the two only different trades are these ones, where these ones are way more volatile. Even though that these two trades together, -1 plus 2, give us 1%, and -21 plus 22 gives us the same thing, 1%. So even though the return is the same, they were more volatile, more risky. So we need to calculate the standard deviation. And this we just use the function standard deviation for a sample. And we just select these data points. And here we go. We have a standard deviation of 6.45%. And here, the standard deviation is obviously going to be higher. Here we go, almost 12%. So way higher. So now what we want to do is calculate the Sharpe ratio. So the Sharpe ratio is going to be daily returns divided by standard deviation times, since earlier, and you know the Sharpe ratio was used to it was used for yearly data. You looked at a year's worth of data, you looked at the return and the standard deviation for each year. Now, since we're looking at daily data, what we need to do is annualize those returns. Now, if you're trading stocks, you have to multiply by the square root, and we don't need to get into the math. Square root of 252, because that's the number of trading days in a year. But since we're trading cryptocurrencies and cryptocurrencies trade every day of the year, we annualize by multiplying times the square root of 365. And here we go. We have a Sharpe ratio here of 6.2. And here you guys can guess the Sharpe ratio is going to be less. Since the standard deviation is bigger, then you know the same number divided by something bigger is going to give us a smaller number, which is 3.3. So I have a Sharpe ratio that is way better for this strategy. That means that this strategy generates for me, you know, a bigger amount of return for 1 unit of risk than this one does. So I would choose this strategy to run. Okay? Because you have to understand that when you're comparing strategies, okay, or even traders, you want to look at the whole picture. So for example, I've had a bunch of people when they used to apply to MTG to trade, and some people would send me their results. They'll be like, hey, I made 100% return in the last, you know, whatever, few months. And I'm like, okay, well, what is your Sharpe ratio? And they didn't know about it. And when somebody doesn't know about Sharpe ratio, I don't even continue with the conversation because I know that they don't understand risk correctly. So for each firm that I've ever worked at, we always looked at the Sharpe ratio. And because a firm would always prefer something like this than something like that. Because imagine this, imagine I take this guy. If I have two people who showed me these results for their historical trades, 100% of the time I would choose this guy. Why? Because I can give this guy 3 times more money, or let's say 2.5 times more money, and he would be able to make the same amount of money as this guy, right? I could just scale him and give him more capital, and he would make the same amount of money. But his standard deviation or his risk would still be lower than this guy, who is so volatile. So we always look at that. Professionally, in any firm, you're going to look at that. And it's for a reason. So with the Sharpe ratio, you're going to be able to compare different strategies with each other, see which strategy you should not run at all, which strategy you should put more capital in, fund it more, which strategies you should just paper trade until they have a good enough Sharpe ratio to be implemented. And yeah, that's it. So in the next lectures, we're going to look at historical trades and how to actually get these numbers for yourself from your historical trades. So I'll see you guys in the next lecture.